The whole purpose of life insurance is to be able to pass on a check to your surviving loved ones. And when we ask people about life insurance, most people can tell us how much they have. You know, for example, they have 100,000, or they have 250,000, or 500,000, or even $1 million. But when you ask them what it's for, they really don't know what it's for, and they don't have a plan. And that is very important, because if one spouse dies and the other one all of a sudden has this big check, a lot of times they don't have a plan for what to do with it. Or if both husband and wife die, the person who's in charge of handling their estate doesn't know where to start. And these are the different categories, and this is called a needs analysis. It's a way to figure out how big your death benefit should be. The first thing that you want to put in your death benefit is final expense coverage. Now, on average in Rochester, a funeral is approximately $12,000 on average. So you may want to think about that number or a different number, maybe someone, family or friend that you know, if you're aware of how much it costs for a funeral. These are your numbers, so I want you to think about how much you want there. Also under final expenses, you want to think about any taxes or probate costs. Also, any attorney fees. Typically as people get older and they acquire assets, there can be probate costs. And when we get together, we can talk more about that. Also in final expenses, you may want to think about any medical expenses that would be there. If you die suddenly of a heart attack, there may not be medical expenses. But if you battle a disease, or you need to go into the hospital after a car accident and you're in critical condition, there may be deductibles and copays there. So think about how much your out-of-pocket maximum is for medical expenses, and also add that into your final expense category. And this is for both husband and wife. The next thing that you want to put inside your death benefit is debts. And at this point, we're not talking about mortgage debt. The only debts that we're talking about are vehicle loans, any personal loans, any credit cards, any student loans, anything like that would go underneath that category. Of course, the point of that is that if the death benefit check was given to the spouse, that they would be able to use a portion of the death benefit to just completely wipe out the debt. The next thing on the list is the emergency fund. And instead of using the emergency fund that you've already completely, built up for a 3 or 6 month emergency fund in your savings account now, it's very inexpensive to just include 3 to 6 months of your income as part of your death benefit. So put down a number under that category, whatever number you feel is appropriate. The next thing on the list is housing, and this is for your mortgage or rent. And you have a choice here. You can either put down a number in that category that would be for paying off the mortgage in full, so that the surviving spouse and kids can live in the house without having a mortgage payment, not have that stress anymore. Or you may think about having enough money in that category to just, for example, pay 5 years of mortgage expenses. So if the mortgage was, just as an easy example, $1,000 a month, that'd be $1,000 a month times 12 months a year, so $12,000 times 5 years. So maybe $60,000 there. And that'd be a situation if you thought it may be a house that you don't want to stay in. but you'd like to be able to comfortably transition, sell the house, and move on. So put down a number there. The next section is childcare. So however old your kids are, you want to think about how long they're going to be in childcare. Think about how much that annual cost is, and put down a number for how many years of expense you want there to be available for childcare. An education fund is for child's college expenses. Right now, as far as a way to figure out what it's going to be in the future, if an annual cost to go to school right now is $20,000, just as an example, and you want to take care of 4 years of college education for your kids, to factor in the inflation, you'd want to take a factor of 2.85. So if it's $20,000 a year to go to school right now, 18 years from now, it'll probably be an estimated $57,000 per child per year to go to school. So if something happens to a husband or wife at a young age, this is a category where that section of the big check can be sliced off, and that amount of money for the education fund can be set aside so that it's no longer a worry on saving up money for children to go to school. The next thing on the list is Survivor's Income Fund, and this is something where you can have 3 years of income replacement, 5 years, 10 years. Some families even do 20 years of income replacement. So put down whatever number you think is appropriate under that section for income replacement. The last section on the list is for special needs, and that's for any money that you want to be left behind for maybe not your children anymore, but if you think about it, as your parents get older, you may also be taking care of them. So if you'd like to put down any money for anyone who's dependent on you, like an elderly parent or a family or friend member that you've taken on the responsibility to help, that'd be another optional thing that you could put there. And so this is certainly a guide towards what an ideal life insurance plan would be. After you get done filling out the numbers for these different sections, the best thing that you could do next is prioritize. Out of all these different sections on the list where you've filled in a number, label them as far as what's most important to what's least important with a number system. And then if you're interested in talking about the different life insurance plans, we can certainly do that. Please get a hold of me with any questions or concerns, and thanks for taking the time to go through this needs analysis.